Nicholas Coriano back again for Servitude Intelligent Relations. We can be found at servitude.com. I have the t-shirt, so it makes it easier for you guys to find us. And today we're talking about convertible debt. What is it? When should it be used? Etc., etc. So what is convertible debt? Convertible debt is debt. So for example, there's a public company, we'll call it Nicky Nice Incorporated. And it's trading, let's say, on the NASDAQ. And it's looking to raise capital. But the person that has the, call it $50 million investment says, I want security for my investment. I'm going to charge you guys a 10% interest rate. That's the debt part of it. But if you guys don't pay that, or at the option of A, B, or C, or at the trigger of A, B, or C, and these are contracts that can be written up specific per situation, that $10 million, $50 million loan will be converted into stock. Okay, that is convertible debt. Okay, so for example, I'll give you another example. I issue $1 million. I'm a private investor. I go to an over-the-counter market company, has very low liquidity. The prospects are a little bit risky. And I say, look, I'm going to let you guys borrow the $1 million, but if you guys can't pay me back the $1 million, I'm going to convert the $1 million debt into 25% of the company. Right? It could be done on a basis of the dollar amount of a stock, on the percentage of the company. This is all can be negotiated. So there are no blanket rules to, what's the average? I've heard this before from some people. Well, what on average can we convert to? This is a negotiation. The better negotiator you are, the better terms you're going to get, whether you're the investor or the management side. So that's convertible debt. If you're a starting, scaling micro cap or penny stock company, this is a great tool to assure potential investors that, hey, if we can't pay you back, you guys are going to get the equity value. From an investment standpoint, it's also a great security that says, hey, look, if they can't give us back our interest rate on the debt, we'll be able to take a certain percentage of the company. Sometimes these convertible debts have other footnotes in the contract, right, in the debt that say, people take on board seats, right? People have taken on, I've seen people take on warrants or options for the company. So it's not always so simple as the debt converts into stock, but that is the basic explanation of what convertible debt is. Okay, convertible debt is you're putting on debt into a certain vehicle, whether it's a public company or a private company, and if they don't pay, or at the triggering event, at some kind of triggering event, whether it's a date, whether it's a price point, whether it's a revenue marker or benchmark, that converts into equity. It can also convert into an option. It can also convert into a warrant. So convertible debt just means it can change from debt to another financial instrument. Meaning, like I said, it could be stock, it could be a warrant, it could be an option. So that's convertible debt. It's a great tool for security on both sides, and it can be used just as diligently on the management side. So a lot of times what we see is this scenario where funders are coming in with convertible debt that basically, for lack of a better word, especially to make it specific to the micro cap sector and the penny stock sector, what happens is you see a lot of funders go in and they'll give them a tranche of money for 100,000, 50,000, 100,000, 250,000, and then it converts. If they can't pay it back, it converts into stock. That person sells out the stock, and then they have the capital to loan the money to the company. Again, this is great when there's no other options. The issue becomes with that if they don't sell it out in a responsible way, there creates this downward pressure on the stock, which makes the stock go down until the point you're at zero, and then triple zero, and then quadruple zeros, and then all of a sudden they can't play that game anymore, right? They can't lend you any more money because when they convert, they're not going to be able to get out of the stock. So make sure that this is reasonable on both sides. Make sure you guys understand where you're going with it. And if you're management, don't go in with the assumption that you want it to convert just because you're trying to cover, overhead costs, unless it's absolutely necessary, because there is an end game with that, right? To converting so much that eventually, especially if the person selling out is not doing it in a manner that keeps the stock price up, it's going to be really hard to continue that strategy. So, but keep in mind that those convertible debts, if you put a larger amount into it and hopefully you guys can cash out, you can also sell that convertible note beforehand as well. So there's scenarios where someone put a convertible note into a company. So here's $1 million, you give me 10% a year until it's paid off. And then when the note comes through, the company doesn't have the money. So it's about to convert, right? And let's say the contract said it was going to convert for 5% of the company, 6% of the company, or a million shares, whatever it may be. Whatever that is, it's going to create more authorized shares in many, not more authorized shares, but more shares outstanding, I'm sorry. And this is going to create, what do you call it? Uh, a downward pressure on the stock, right? So instead of that, what some companies do is they sell that convertible debt to another third-party financier. So let's say there's $1 million about to convert into stock. They'll have another third-party financier with different terms, right? Buy out the guy at 10% and maybe put a 12%, 15% on the debt to extend it out another 3 months, 6 months, or they take the conversion at a higher rate at a later time period. So these deals can always be negotiated in and out, but it is a tool. If you didn't know about it, definitely look into it when you're looking at raising capital. Convertible debt that can be converted into another instrument, basically, whether it's equity in stock, common stock form. It could be converted into preferred stock. It could be converted into options. It can be converted into warrants. So it really depends on what goes on at the negotiating table. So I hope that was helpful. If you guys need help navigating the capital markets, reach out to us at servitude.com. We definitely help clients with investor relations, tactics, strategies, and implementation services, as well as marketing services. So if you need to market your company and you need to get out in front, reach out to us. We can definitely help. Share this video if you think it'll help somebody else, and have a great day, guys.